As Graham liked to say, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Yahoo won the short-term popularity contest, but in the end, it's earnings that matter, and Yahoo barely had any. Once the market stopped voting and started weighing, the scales tipped toward Yum. Its stock rose 25.4% from 2000 through 2002, while Yahoo's lost 92.4% cumulatively. Pair 3. Commerce One and Capital One. In May 2000, Commerce One Incorporated had been publicly traded only since the previous July. In its first annual report, the company, which designs internet exchanges for corporate purchasing departments, showed assets of just $385 million and reported a net loss of $63 million on only $34 million in total revenues. The stock of this minuscule company had risen nearly 900% since its IPO, hitting a total market capitalization of $15 billion. Was it overpriced? Yes, we have a big market cap, Commerce One's chief executive Mark Hoffman shrugged in an interview. But we have a big market to play in. We're seeing incredible demand. Analysts expect us to make $140 million in revenue this year, and in the past we've exceeded expectations. Two things jump out from Hoffman's answer. Since Commerce One was already losing $2 on every dollar in sales, if it quadrupled its revenues, as analysts expect, wouldn't it lose money even more massively? How could Commerce One have exceeded expectations in the past? What past? Asked whether his company would ever turn a profit, Hoffman was ready. There is no question we can turn this into a profitable business. We plan on becoming profitable in the fourth quarter of 2001. A year analysts see us making over $250 million in revenues. There come those analysts again. I like Commerce One at these levels because it's growing faster than Ariba, a close competitor whose stock was also trading at around 400 times revenues, said Jeanette Singh, an analyst at the Wasserstein-Perella Investment Bank. If these growth rates continue, Commerce One will be trading at 60 to 70 times sales in 2001. In other words, I can name a stock that's more overpriced than Commerce One, so Commerce One is cheap. At the other extreme was Capital One Financial Corporation, an issuer of MasterCard and Visa credit cards. From July 1999 to May 2000, its stock lost 21.5%. Yet Capital One had $12 billion in total assets and earned $363 million in 1999, up 32% from the year before. With a market value of about $7.3 billion, the stock sold at 20 times Capital One's net earnings. All might not be well at Capital One. The company had barely raised its reserves for loans that might go bad, even though default rates tend to jump in a recession. But its stock price reflected at least some risk of potential trouble. What happened next? In 2001, Commerce One generated $409 million in revenues. Unfortunately, it ran a net loss of $2.6 billion, or $10.30 of red ink per share, on those revenues. Capital One, on the other hand, earned nearly $2 billion in net income in 2000 through 2002. Its stock lost 38% in those 3 years, no worse than the stock market as a whole. Commerce One, however, lost 99.7% of its value. Instead of listening to Hoffman and his lapdog analysts, traders should have heeded the honest warning in Commerce One's annual report for 1999. We have never been profitable. We expect to incur net losses for the foreseeable future, and we may never be profitable. Pair 4, Palm and 3Com. On March 2, 2000, the data networking company 3Com Corporation sold 5% of its Palm Incorporated subsidiary to the public. The remaining 95% of Palm stock would be spun off to 3Com shareholders in the next few months. For each share of 3Com they held, investors would receive 1.525 shares of Palm. So there were two ways you could get 100 shares of Palm: by trying to elbow your way into the IPO, or by buying 66 shares of 3Com and waiting until the parent company distributed the rest of the Palm stock. Getting 1.5 shares of Palm for each 3Com share, you'd end up with 100 shares of the new company, and you'd still have 66 shares of 3Com. But who wanted to wait a few months? While 3Com was struggling against giant rivals like Cisco, Palm was a leader in the hot space of handheld digital organizers. So Palm's stock shot up from its offering price of $38 to close at $95.06, a 150% first-day return. That valued Palm at more than 1,350 times its earnings over the previous 12 months. That same day, 3Com share price dropped from $104.13 to $81.81. Where should 3Com have closed that day, given the price of Palm? The arithmetic is easy. Each 3Com share was entitled to receive 1.525 shares of Palm. Each share of Palm closed at $95.06. 1.525 times 95.06 equals $144.97. That's what each 3Com share was worth, based on its stake in Palm alone. Thus, at $81.81, traders were saying that all of 3Com's other businesses combined were worth a negative $63.16 per share, or a total of minus $22 billion. Rarely in history has any stock been priced more stupidly. But there was a catch. Just as 3Com wasn't really worth minus $22 billion, Palm wasn't really worth over 1,350 times earnings. By the end of 2002, both stocks were hurting in the high-tech recession, but it was Palm's shareholders who really got smacked because they abandoned all common sense when they bought in the first place. Pair 5. CMGI and CGI. The year 2000 started off with a bang for CMGI Incorporated as the stock hit $163.22 on January 3rd, a gain of 1,126% over its price just 1 year before. The company, an internet incubator, financed and acquired startup firms in a variety of online businesses, among them such early stars as theglobe.com and Lycos. In fiscal year 1998, as its stock rose from 98 cents to $8.52, CMGI spent $53.8 million acquiring whole or partial stakes in internet companies. In fiscal year 1999, as its stock shot from $8.52 to $46.09, CMGI shelled out $104.7 million. And in the last 5 months of 1999, as its shares zoomed up to $138.44, CMGI spent $4.1 billion on acquisitions. Virtually all the money was CMGI's own privately minted currency, its common stock, now valued at a total of more than $40 billion. It was a kind of magical money merry-go-round. The higher CMGI's own stock went, the more it could afford to buy. The more CMGI could afford to buy, the higher its stock went. First, stocks would go up on the rumor that CMGI might buy them. Then, once CMGI acquired them, its own stock would go up because it owned them. No one cared that CMGI had lost $127 million on its operations in the latest fiscal year. Down in Webster, Massachusetts, less than 70 miles southwest of CMGI's headquarters in Andover, sits the main office of Commerce Group Incorporated. CGI was everything CMGI was not. Offering automobile insurance, mainly to drivers in Massachusetts, it was a cold stock in an old industry. Its shares lost 23% in 1999. Although its net income at $89 million ended up falling only 7% below 1998's level. CGI even paid a dividend of more than 4%. CMGI paid none. With a total market value of $870 million, CGI stock was trading at less than 10 times what the company would earn for 1999. And then, quite suddenly, everything went into reverse. CMGI's magical money merry-go-round screeched to a halt. Its dot-com stocks stopped rising in price, then went straight down. No longer able to sell them for a profit, CMGI had to take their loss in value as a hit to its earnings. The company lost $1.4 billion in 2000, $5.5 billion in 2001, and nearly $500 million more in 2002. Its stock went from $163.22 at the beginning of 2000 to 98 cents by year-end 2002, a loss of 99.4%. Boring old CGI, however, kept cranking out steady earnings, and its stock rose 8.5% in 2000, 43.6% in 2001, and 2.7% in 2002, a 60% cumulative gain. Pair 6. Ball and Stryker. Between July 9th and July 23rd, 2002, Ball Corporation's stock dropped from $43.69 to $33.48, a loss of 24% that left the company with a stock market value of $1.9 billion. Over the same 2 weeks, Stryker Corporation shares fell from $49.55 to $45.60, an 8% drop that left Stryker valued at a total of $9 billion. What had made these two companies worth so much less in so short a time? Stryker, which manufactures orthopedic implants and surgical equipment, issued only one press release during those 2 weeks. On July 16th, Stryker announced that its sales grew 15% to $734 million in the second quarter, while earnings jumped 31% to $86 million. The stock rose 7% the next day, then rolled right back downhill. Ball, the original maker of the famous Ball jars used for canning fruits and vegetables, now makes metal and plastic packaging for industrial customers. Ball issued no press releases at all during those 2 weeks. On July 25th, however, Ball reported that it had earned $50 million on sales of $1 billion in the second quarter, a 61% rise in net income over the same period 1 year earlier. That brought its earnings over the trailing 4 quarters to $152 million, so the stock was trading at just 12.5 times Ball's earnings. And with a book value of $1.1 billion, you could buy the stock for 1.7 times what the company's tangible assets were worth. Ball did, however, have just over $900 million in debt. Stryker was in a different league. Over the last 4 quarters, the company had generated $301 million in net income. Stryker's book value was $570 million. So the company was trading at fat multiples of 30 times its earnings over the past 12 months, and nearly 16 times its book value. On the other hand, from 1992 through the end of 2001, Stryker's earnings had risen 18.6% annually. Its dividend had grown by nearly 21% per year, and in 2001, Stryker had spent $142 million on research and development to lay the groundwork for future growth. What then had pounded these two stocks down? Between July 9th and July 23rd, 2002, as WorldCom keeled over into bankruptcy, the Dow Jones Industrial Average fell from 9,096.09 to 7,702.34, a 15.3% plunge. The good news at Ball and Stryker got lost in the bad headlines and falling markets, which took these two stocks down with them. Although Ball ended up priced far more cheaply than Stryker, the lesson here is not that Ball was a steal and Stryker was a wild pitch. Instead, the intelligent investor should recognize that market panics can create great prices for good companies like Ball. and good prices for great companies like Stryker. Ball finished 2002 at $51.19 a share, up 53% from its July low. Stryker ended the year at $67.12, up 47%. Every once in a while, value and growth stocks alike go on sale. Which choice you prefer depends largely on your own personality, but bargains can be had on either side of the plate. Pair 7. Nortel and Nortec. The 1999 annual report for Nortel Networks, the fiber optic equipment company, boasted that it was a golden year financially. As of February 2000, at a market value of more than $150 billion, Nortel's stock traded at 87 times the earnings that Wall Street analysts estimated the company would produce in 2000. How credible was that estimate? Nortel's accounts receivable, sales to customers that had not yet paid the bill, had shot up by $1 billion in a year. The company said the rise was driven by increased sales in the fourth quarter of 1999. However, inventories had also ballooned by $1.2 billion, meaning that Nortel was producing equipment even faster than those increased sales could unload it. Meanwhile, Nortel's long-term receivables, bills not yet paid for multi-year contracts, jumped from $519 million to $1.4 billion. And Nortel was having a hard time controlling costs. Its selling, general, and administrative expense, or overhead, had risen from 17.6% of revenues in 1997 to 18.7% in 1999. All told, Nortel had lost $350 million in 1999. Then there was Nortec Incorporated, which produces stuff at the dim end of the glamour spectrum: vinyl siding, door chimes, exhaust fans, range hoods, trash compactors. In 1999, Nortec earned $49 million on $2 billion in net sales, up from $21 million in net income on $1.1 billion in net sales in 1997. Nortec's profit margin, net earnings as a percentage of net sales, had risen by almost a third, from 1.9% to 2.5%, and Nortec had cut overhead from 19.3% of revenues to 18.1%. To be fair, much of Nortec's expansion came from buying other companies, not from internal growth. What's more, Nortec had $1 billion in debt, a big load for a small firm. But in February 2000, Nortec's stock price, roughly 5 times its earnings in 1999, included a healthy dose of pessimism. On the other hand, Nortel's price, 87 times the guesstimate of what it might earn in the year to come, was a massive overdose of optimism. When all was said and done, instead of earning the $1.30 per share that analysts had predicted, Nortel lost $1.17 per share in 2000. By the end of 2002, Nortel had bled more than $36 billion in red ink. Nortec, on the other hand, earned $41.6 million in 2000, $8 million in 2001, and $55 million in the first 9 months of 2002. Its stock went from $28 a share to $45.75 by year-end 2002, a 63% gain. In January 2003, Nortec's managers took the company private, buying all the stock from public investors at $46 per share. Nortel's stock, meanwhile, sank from $56.81 in February 2000 to $1.61 at year-end 2002, a 97% loss. Pair 8. Red Hat and Brown Shoe. On August 11, 1999, Red Hat Incorporated, a developer of Linux software, sold stock to the public for the first time. Red Hat was red hot. Initially offered at $7, the shares opened for trading at $23 and closed at $26.03, a 272% gain. In a single day, Red Hat stock had gone up more than Brown Shoes had in the previous 18 years. By December 9th, Red Hat shares hit $143.13, up 1,944% in 4 months. Brown Shoe, meanwhile, had its laces tied together. Founded in 1878, the company wholesales Buster Brown shoes and runs nearly 1,300 footwear stores in the United States and Canada. Brown Shoes stock, at $17.50 a share on August 11th, stumbled down to $14.31 by December 9th. For all of 1999, Brown Shoes shares lost 17.6%. Besides a cool name and a hot stock, what did Red Hat's investors get? Over the 9 months ending November 30th, the company produced $13 million in revenues, on which it ran a net loss of $9 million. Red Hat's business was barely bigger than a street corner delicatessen and a lot less lucrative. But traders, inflamed by the words software and internet, drove the total value of Red Hat shares to $21.3 billion by December 9th. And Brown Shoe? Over the previous 3 quarters, the company had produced $1.2 billion in net sales and $32 million in earnings. Brown Shoe had nearly $5 a share in cash and real estate. Kids were still buying Buster Brown shoes. Yet that December 9th, Brown Shoes stock had a total value of $261 million, barely 1/80th the size of Red Hat, even though Brown Shoe had 100 times Red Hat's revenues. At that price, Brown Shoe was valued at 7.6 times its annual earnings and less than 1/4 of its annual sales. Red Hat, on the other hand, had no profits at all, while its stock was selling at more than 1,000 times its annual sales. Red Hat, the company, kept right on gushing red ink. Soon enough, the stock did too. Brown Shoe, however, trudged out more profits, and so did its shareholders. What have we learned? The market scoffs at Graham's principles in the short run, but they are always revalidated in the end. If you buy a stock purely because its price has been going up, instead of asking whether the underlying company's value is increasing, then sooner or later you will be extremely sorry. That's not a likelihood. It is a certainty. Chapter 19. Shareholders and Management's Dividend Policy. Ever since 1934, we've argued in our writings for a more intelligent and energetic attitude by shareholders toward their managements. We've asked them to take a generous attitude toward those who are demonstrably doing a good job. We've asked them also to demand clear and satisfying explanations when the results appear to be worse than they should be, and to support movements to improve or remove clearly unproductive managements. Shareholders are justified in raising questions as to the competence of the management when the results, 1, are unsatisfactory in themselves, 2, are poorer than those obtained by other companies that appear similarly situated, and 3, have resulted in an unsatisfactory market price of long duration. In the last 36 years, practically nothing has actually been accomplished through intelligent action by the great body of shareholders. A sensible crusader, if there are any such, would take this as a sign that he has been wasting his time and that he had better give up the fight. As it happens, our cause has not been lost. It has been rescued by an extraneous development known as takeovers or takeover bids. We said in Chapter 8 that poor management produces poor market prices. The low market prices, in turn, attract the attention of companies interested in diversifying their operations. And these are now legion. Innumerable such acquisitions have been accomplished by agreement with the existing managements, or else by accumulation of shares in the market and by offers made over the head of those in control. The price bid has usually been within the range of the value of the enterprise under reasonably competent management. Hence, in many cases, the inert public shareholder has been bailed out by the actions of outsiders, who at times may be enterprising individuals or groups acting on their own. It can be stated as a rule, with very few exceptions, that poor managements are not changed by action of the public stockholders, but only by the assertion of control by an individual or compact group. This is happening often enough these days to put the management, including the board of directors of a typically publicly controlled company, on notice that if its operating results and the resulting market price are highly unsatisfactory, it may become the target of a successful takeover move. As a consequence, boards of directors have probably become more alive than previously to their fundamental duty to see that their company has a satisfactory top management. Many more changes of presidents have been seen in recent years than formerly. Not all companies in the unsatisfactory class have benefited from such developments. Also, the changes often occurred after a long period of bad results without remedial action, and has depended on enough disappointed shareholders selling out at low prices to permit the energetic outsiders to acquire a controlling position in the shares. But the idea that public shareholders could really help themselves by supporting moves for improving management and management policies has proved too quixotic to warrant further space in this audiobook. Those individual shareholders who have enough gumption to make their presence felt at annual meetings, generally a completely futile performance, will not need our counsel on what points to raise with the managements. For others, the advice would probably be wasted. Nevertheless, let us close this section with the plea that shareholders consider with an open mind and with careful attention any proxy material sent them by fellow shareholders who want to remedy an obviously unsatisfactory management situation in the company. Shareholders and dividend policy. In the past, the dividend policy was a fairly frequent subject of argument between public or minority shareholders and managements. In general, these shareholders wanted more liberal dividends, while the managements preferred to keep the earnings in the business to strengthen the company. They asked the shareholders to sacrifice their present interests for the good of the enterprise and for their own future long-term benefit. But in recent years, the attitude of investors toward dividends has been undergoing a gradual but significant change. The basic argument now for paying small rather than liberal dividends is not that the company needs the money, but rather that it can use it to the shareholders' direct and immediate advantage by retaining the funds for profitable expansion. Years ago, it was typically the weak company that was more or less forced to hold on to its profits instead of paying out the usual 60% to 75% of them in dividends. The effect was almost always adverse to the market price of the shares. Nowadays, it is quite likely to be a strong and growing enterprise that deliberately keeps down its dividend payments, with the approval of investors and speculators alike. There was always a strong theoretical case for reinvesting profits in the business where such retention could be counted on to produce a goodly increase in earnings. But there were several strong counter-arguments, such as the profits belong to the shareholders, and they are entitled to have them paid out within the limits of prudent management. Many of the shareholders need their dividend income to live on. The earnings they receive in dividends are real money, while those retained in the company may or may not show up later as tangible values for the shareholders. These counter-arguments were so compelling, in fact, that the stock market showed a persistent bias in favor of the liberal dividend payers, as against the companies that paid no dividends or relatively small ones. In the last 20 years, the profitable reinvestment theory has been gaining ground. The better the past record of growth, the readier investors and speculators have become to accept a low payout policy. So much is this true that in many cases of growth favorites, the dividend rate, or even the absence of any dividend, has seemed to have virtually no effect on the market price. A striking example of this development is found in the history of Texas Instruments Incorporated. The price of its common stock rose from $5 in 1953 to $256 in 1960. while earnings were advancing from 43 cents to $3.91 per share, and while no dividend of any kind was paid. In 1962, cash dividends were initiated, but by that year the earnings had fallen to $2.14, and the price had shown a spectacular drop to a low of 49. Another extreme illustration is provided by Superior Oil. In 1948, the company reported earnings of $35.26 per share, paid $3 in dividends, and sold as high as $235. In 1953, the dividend was reduced to $1, but the high price was $660. In 1957, it paid no dividend at all and sold at $2,000. This unusual issue later declined to $795 in 1962, when it earned $49.50 and paid $7.50. Investment sentiment is far from crystallized in this matter of dividend policy of growth companies. The conflicting views are well illustrated by the cases of two of our very largest corporations, American Telephone and Telegraph, and International Business Machines. American Tel came to be regarded as an issue with good growth possibilities, as shown by the fact that in 1961 it sold at 25 times that year's earnings. Nevertheless, the company's cash dividend policy has remained an investment and speculative consideration of first importance, its quotation making an active response to even rumors of an impending increase in the dividend rate. On the other hand, comparatively little attention appears to have been paid to the cash dividend on IBM, which in 1960 yielded only 0.5% at the high price of the year, and 1.5% at the close of 1970. But in both cases, stock splits have operated as a potent stock market influence. The market's appraisal of cash dividend policy appears to be developing in the following direction. Where prime emphasis is not placed on growth, the stock is rated as an income issue, and the dividend rate retains its long-held importance as the prime determinant of market price. At the other extreme, stocks clearly recognized to be in the rapid growth category are valued primarily in terms of the expected growth rate over, say, the next decade, and the cash dividend rate is more or less left out of the reckoning. While this prior statement may properly describe present tendencies, it is by no means a clear-cut guide to the situation in all common stocks, and perhaps not in the majority of them. For one thing, many companies occupy an intermediate position between growth and non-growth enterprises. It is hard to say how much importance should be ascribed to the growth factor in such cases, and the market's view thereof may change radically from year to year. Secondly, there seems to be something paradoxical about requiring the companies showing slower growth to be more liberal with their cash dividends, for these are generally the less prosperous concerns, and in the past, the more prosperous the company, the greater was the expectation of both liberal and increasing payments. It is our belief that shareholders should demand of their managements either a normal payout of earnings, on the order, say, of 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in per-share earnings. Such a demonstration could ordinarily be made in the case of a recognized growth company, but in many other cases, a low payout is clearly the cause of an average market price that is below fair value, and here the shareholders have every right to inquire and probably to complain. A niggardly policy has often been imposed on a company because its financial position is relatively weak, and it has needed all or most of its earnings, plus depreciation charges, to pay debts and bolster its working capital position. When this is so, there is not much the shareholders can say about it, except perhaps to criticize the management for permitting the company to fall into such an unsatisfactory financial position. However, dividends are sometimes held down by relatively unprosperous companies for the declared purpose of expanding the business. We feel that such a policy is illogical on its face, and should require both a complete explanation and a convincing defense before the shareholder should accept it. In terms of the past record, there is no reason a priori to believe that the owners will benefit from expansion moves undertaken with their money by a business showing mediocre results and continuing its old management. Stock dividends and stock splits. It is important that investors understand the essential difference between a stock dividend, properly so called, and a stock split. The latter represents a restatement of the common stock structure, in a typical case by issuing 2 or 3 shares for one. The new shares are not related to specific earnings reinvested in a specific past period. Its purpose is to establish a lower market price for the single shares, presumably because such lower price range would be more acceptable to old and new shareholders. A stock split may be carried out by what technically may be called a stock dividend, which involves a transfer of sums from earned surplus to capital account, or else by a change in par value, which does not affect the surplus account. What we should call a proper stock dividend is one that is paid to shareholders to give them a tangible evidence or representation of specific earnings which have been reinvested in the business for their account over some relatively short period in the recent past, say not more than 2 preceding years. It is now approved practice to value such a stock dividend at the approximate value at the time of declaration, and to transfer an amount equal to such value from earned surplus to capital accounts. Thus, the amount of a typical stock dividend is relatively small, in most cases not more than 5%. In essence, a stock dividend of this sort has the same overall effect as the payment of an equivalent amount of cash out of earnings, when accompanied by the sale of additional shares of like total value to the shareholders. However, a straight stock dividend has an important tax advantage over the otherwise equivalent combination of cash dividends with stock subscription rights, which is the almost standard practice for public utility companies. The New York Stock Exchange has set the figure of 25% as a practical dividing line between stock splits and stock dividends. Those of 25% or more need not be accompanied by the transfer of their market value from earned surplus to capital, and so forth. Some companies, especially banks, still follow the old practice of declaring any kind of stock dividend they please, for example, one of 10%, not related to recent earnings, and these instances maintain an undesirable confusion in the financial world. We have long been a strong advocate of a systematic and clearly enunciated policy with respect to the payment of cash and stock dividends. Under such a policy, stock dividends are paid periodically to capitalize all or a stated portion of the earnings reinvested in the business. Such a policy, covering 100% of the reinvested earnings, has been followed by Purex, Government Employees Insurance, and perhaps a few others. Stock dividends of all types seem to be disapproved of by most academic writers on the subject. They insist that they are nothing but pieces of paper, that they give the shareholders nothing they did not have before, and that they entail needless expense and inconvenience. On our side, we consider this a completely doctrinaire view, which fails to take into account the practical and psychological realities of investment. True, a periodic stock dividend, say of 5%, changes only the form of the owner's investment. He has 105 shares in place of 100. But without the stock dividend, the original 100 shares would have represented the same ownership interest now embodied in his 105 shares. Nonetheless, the change of form is actually one of real importance and value to him. If he wishes to cash in his share of the reinvested profits, he can do so by selling the new certificate sent him, instead of having to break up his original certificate. He can count on receiving the same cash dividend rate on 105 shares as formerly on his 100 shares. A 5% rise in the cash dividend rate without the stock dividend would not be nearly as probable. The advantages of a periodic stock dividend policy are most evident when it is compared with the usual practice of the public utility companies of paying liberal cash dividends and then taking back a good part of this money from the shareholders by selling them additional stock through subscription rights. As we mentioned before, the shareholders would find themselves in exactly the same position if they received stock dividends in lieu of the popular combination of cash dividends followed by stock subscriptions, except that they would save the income tax otherwise paid on the cash dividends. Those who need or wish the maximum annual cash income with no additional stock can get this result by selling their stock dividends, in the same way as they sell their subscription rights under present practice. The aggregate amount of income tax that could be saved by substituting stock dividends for the present stock dividends plus subscription rights combination is enormous. We urge that this change be made by the public utilities, despite its adverse effect on the U.S. Treasury, because we are convinced that it is completely inequitable to impose a second personal income tax on earnings which are not really received by the shareholders, since the companies take the same money back through sales of stock. Efficient corporations continuously modernize their facilities, their products, their bookkeeping, their management training programs, their employee relations. It is high time they thought about modernizing their major financial practices, not the least important of which is their dividend policy. Commentary on Chapter 19. The most dangerous untruths are truths slightly distorted. G.C. Lichtenberg. Why did Graham throw in the towel? Perhaps no other part of The Intelligent Investor was more drastically changed by Graham than this. In the first edition, this chapter was one of a pair that together ran nearly 34 pages. That original section, The Investor as Business Owner, dealt with shareholders' voting rights, ways of judging the quality of corporate management, and techniques for detecting conflicts of interest between insiders and outside investors. By his last revised edition, however, Graham had pared the whole discussion back to less than 8 terse pages about dividends. Why did Graham cut away more than 3/4 of his original argument? After decades of exhortation, he evidently had given up hope that investors would ever take any interest in monitoring the behavior of corporate managers. But the latest epidemic of scandal, allegations of managerial misbehavior, shady accounting, or tax maneuvers at major firms like AOL, Enron, Global Crossing, Sprint, Tyco, and WorldCom is a stark reminder that Graham's earlier warnings about the need for eternal vigilance are more vital than ever. Let's bring them back and discuss them in light of today's events. Theory versus practice. Graham begins his original 1949 discussion of the investor as business owner by pointing out that, in theory, the stockholders as a class are king. Acting as a majority, they can hire and fire managements and bend them completely to their will. But in practice, says Graham, the shareholders are a complete washout. As a class, they show neither intelligence nor alertness. They vote in sheep-like fashion for whatever the management recommends, and no matter how poor the management's record of accomplishment may be, the only way to inspire the average American shareholder to take any independently intelligent action would be by exploding a firecracker under him. We cannot resist pointing out the paradoxical fact that Jesus seems to have been a more practical businessman than our American shareholders. Graham wants you to realize something basic but incredibly profound. When you buy a stock, you become an owner of the company. Its managers, all the way up to the CEO, work for you. Its board of directors must answer to you. Its cash belongs to you. Its businesses are your property. If you don't like how your company is being managed, you have the right to demand that the managers be fired, the directors be changed, or the property be sold. Stockholders, declares Graham, should wake up. The intelligent owner. Today's investors have forgotten Graham's message. They put most of their effort into buying a stock, a little into selling it, but none into owning it. Certainly, Graham reminds us there is just as much reason to exercise care and judgment in being as in becoming a stockholder. So how should you, as an intelligent investor, go about being an intelligent owner? Graham starts by telling us that there are just two basic questions to which stockholders should turn their attention. 1. Is the management reasonably efficient? 2. Are the interests of the average outside shareholder receiving proper recognition? You should judge the efficiency of management by comparing each company's profitability, size, and competitiveness against similar firms in its industry. What if you conclude that the managers are no good? Then, urges Graham, a few of the more substantial stockholders should become convinced that a change is needed and should be willing to work toward that end. Second, the rank and file of the stockholders should be open-minded enough to read the proxy material and to weigh the arguments on both sides. They must at least be able to know when their company has been unsuccessful and be ready to demand more than artful platitudes as a vindication of the incumbent management. Third, it would be most helpful when the figures clearly show that the results are well below average if it became the custom to call in outside business engineers to pass upon the policies and competence of the management. The Enron End Run. Back in 1999, Enron Corporation ranked 7th on the Fortune 500 list of America's top companies. The energy giant's revenues, assets, and earnings were all rising like rockets. But what if an investor had ignored the glamour and glittering numbers and had simply put Enron's 1999 proxy statement under the microscope of common sense? Under the heading Certain Transactions, the proxy disclosed that Enron's chief financial officer, Andrew Fastow, was the managing member of two partnerships, LJM1 and LJM2, that bought energy and communications-related investments. And where was LJM1 and LJM2 buying from? Why, where else but from Enron? The proxy reported that the partnerships had already bought $170 million of assets from Enron, sometimes using money borrowed from Enron. The intelligent investor would immediately have asked, did Enron's directors approve this arrangement? Yes, said the proxy. Would Fastow get a piece of LJM's profits? Yes, said the proxy. As Enron's chief financial officer, was Fastow obligated to act exclusively in the interests of Enron's shareholders? Of course. Was Fastow therefore duty-bound to maximize the price Enron obtained for any assets it sold? Absolutely. But if LJM paid a high price for Enron's assets, would that lower LJM's potential profits and Fastow's personal income? Clearly. On the other hand, if LJM paid a low price, would that raise profits for Fastow and his partnerships but hurt Enron's income? Clearly. Should Enron lend Fastow's partnerships any money to buy assets from Enron that might generate a personal profit for Fastow? Say what? Doesn't all this constitute profoundly disturbing conflicts of interest? No other answer is even possible. What does this arrangement say about the judgment of the directors who approved it? It says you should take your investment dollars elsewhere. Two clear lessons emerge from this disaster. Never dig so deep into the numbers that you check your common sense at the door. And always read the proxy statement before and after you buy a stock. What is proxy material? And why does Graham insist that you read it? In its proxy statement, which it sends to every shareholder, a company announces the agenda for its annual meeting and discloses details about the compensation and stock ownership of managers and directors, along with transactions between insiders and the company. Shareholders are asked to vote on which accounting firm should audit the books and who should serve on the board of directors. If you use your common sense while reading the proxy, this document can be like a canary in a coal mine, an early warning system signaling that something is wrong. Yet on average, between a third and a half of all individual investors cannot be bothered to vote their proxies. Do they even read them? Understanding and voting your proxy is every bit as fundamental to being an intelligent investor as following the news and voting your conscience is to being a good citizen. It doesn't matter if you own 10% of a company or with your piddling 100 shares just 1/10,000th of 1%. If you've never read the proxy of a stock you own and the company goes bust, the only person you should blame is yourself. If you do read the proxy and see things that disturb you, then vote against every director to let them know you disapprove. Attend the annual meeting and speak up for your rights. Find an online message board devoted to the stock, like those at http://finance.yahoo.com, and rally other investors to join your cause. Graham had another idea that could benefit today's investors. There are advantages to be gained through the selection of one or more professional and independent directors. These should be men of wide business experience who can turn a fresh and expert eye on the problems of the enterprise. They should submit a separate annual report, addressed directly to the stockholders and containing their views on the major question which concerns the owners of the enterprise. Is the business showing the results for the outside stockholder which could be expected of it under proper management? If not, why? And what should be done about it? One can only imagine the consternation that Graham's proposal would cause among the corporate cronies and golfing buddies who constitute so many of today's independent directors. Let's not suggest that it might send a shudder of fear down their spines, since most independent directors do not appear to have a backbone. Whose money is it anyway? Now let's look at Graham's second criterion, whether management acts in the best interests of outside investors. Managers have always told shareholders that they, the managers, know best what to do with the company's cash. Graham saw right through this managerial malarkey. A company's management may run the business well and yet not give the outside stockholders the right results for them, because its efficiency is confined to operations and does not extend to the best use of the capital. The objective of efficient operation is to produce at low cost and to find the most profitable articles to sell. Efficient finance requires that the stockholders' money be working in forms most suitable to their interest. This is a question in which management, as such, has little interest. Actually, it almost always wants as much capital from the owners as it can possibly get, in order to minimize its own financial problems. Thus, the typical management will operate with more capital than necessary, if the stockholders permit it, which they often do. In the late 1990s and into the early 2000s, the managements of leading technology companies took this daddy knows best attitude to new extremes. The argument went like this: why should you demand a dividend when we can invest that cash for you and turn it into a rising share price? Just look at the way our stock has been going up. Doesn't that prove that we can turn your pennies into dollars better than you can? Incredibly, investors fell for it, hook, line, and sinker. Daddy Knows Best became such gospel that by 1999, only 3.7% of the companies that first sold their stock to the public that year paid a dividend, down from an average of 72.1% of all IPOs in the 1960s. Just look at how the percentage of companies paying dividends, shown in the dark area of figure 19.1, which can be found on the enhancement, has withered away. But Daddy Knows Best was nothing but bunk. While some companies put their cash to good use, many more fell into two other categories: those that simply wasted it, and those that piled it up far faster than they could possibly spend it. In the first group, Priceline.com wrote off $67 million in losses in 2000 after launching goofy ventures into groceries and gasoline, while Amazon.com destroyed at least $233 million of its shareholders' wealth by investing in bombs like Webvan and Ashford.com. And the two biggest losses so far on record, JDS Uniphase's $56 billion in 2001 and AOL Time Warner's $99 billion in 2002, occurred after companies chose not to pay dividends, but to merge with other firms at a time when their shares were obscenely overvalued. In the second group, consider that by late 2001, Oracle Corporation had piled up $5 billion in cash. Cisco Systems had hoarded at least $7.5 billion. Microsoft had amassed a mountain of cash $38.2 billion high and rising by an average of more than $2 million per hour. Just how rainy a day was Bill Gates expecting anyway? So the anecdotal evidence clearly shows that many companies don't know how to turn excess cash into extra returns. What does the statistical evidence tell us? Research by money managers Robert Arnott and Clifford Asness found that when current dividends are low, future corporate earnings also turn out to be low, and when current dividends are high, so are future earnings. Over 10-year periods, the average rate of earnings growth was 3.9 points greater when dividends were high than when they were low. Columbia accounting professors Doran Nissim and Amir Ziv found that companies that raise their dividend not only have better stock returns, but that dividend increases are associated with higher future profitability for at least 4 years after the dividend change. In short, most managers are wrong when they say that they can put your cash to better use than you can. Paying out a dividend does not guarantee great results, but it does improve the return of the typical stock by yanking at least some cash out of the manager's hands before they can either squander it or squirrel it away. Selling low, buying high. What about the argument that companies can put spare cash to better use by buying back their own shares? When a company repurchases some of its stock, that reduces the number of its shares outstanding. Even if its net income stays flat, the company's earnings per share will rise, since its total earnings will be spread across fewer shares. That, in turn, should lift the stock price. Better yet, unlike a dividend, a buyback is tax-free to investors who don't sell their shares. Thus, it increases the value of their stock without raising their tax bill. And if the shares are cheap, then spending spare cash to repurchase them is an excellent use of the company's capital. All this is true in theory. Unfortunately, in the real world, stock buybacks have come to serve a purpose that can only be described as sinister. Now that grants of stock options have become such a large part of executive compensation, many companies, especially in high-tech industries, must issue hundreds of millions of shares to give to the managers who exercise those stock options. But that would jack up the number of shares outstanding and shrink earnings per share. To counteract that dilution, the companies must turn right back around and repurchase millions of shares in the open market. By 2000, companies were spending an astounding 41.8% of their total net income to repurchase their own shares, up from 4.8% in 1980. Let's look at Oracle Corporation, the software giant. Between June 1, 1999 and May 31, 2000, Oracle issued 101 million shares of common stock to its senior executives and another 26 million to employees at a cost of $484 million. Meanwhile, to keep the exercise of earlier stock options from diluting its earnings per share, Oracle spent $5.3 billion, or 52% of its total revenues that year, to buy back 290.7 million shares of stock. Oracle issued the stock to insiders at an average price of $3.53 per share and repurchased it at an average price of $18.26. Sell low, buy high. Is this any way to enhance shareholder value? By 2002, Oracle's stock had fallen to less than half its peak in 2000. Now that its shares were cheaper, did Oracle hasten to buy back more stock? Between June 1, 2001 and May 31, 2002, Oracle cut its repurchases to $2.8 billion, apparently because its executives and employees exercised fewer options that year. The same sell low, buy high pattern is evident at dozens of other technology companies. What's going on here? Two surprising factors are at work. Companies get a tax break when executives and employees exercise stock options, which the IRS considers a compensation expense to the company. In its fiscal years from 2000 through 2002, for example, Oracle reaped $1.69 billion in tax benefits as insiders cashed in on options. Sprint Corporation pocketed $678 million in tax benefits as its executives and employees locked in $1.9 billion in options profits in 1999 and 2000. A senior executive heavily compensated with stock options has a vested interest in favoring stock buybacks over dividends. Why? For technical reasons, options increase in value as the price fluctuations of a stock grow more extreme. But dividends dampen the volatility of a stock's price, so if the managers increased the dividend, they would lower the value of their own stock options. No wonder CEOs would much rather buy back stock than pay dividends, regardless of how overvalued the shares may be or how drastically that may waste the resources of the outside shareholders. Keeping their options open. Finally, drowsy investors have given their companies free rein to overpay executives in ways that are simply unconscionable. In 1997, Steve Jobs, the co-founder of Apple Computer Incorporated, returned to the company as its interim chief executive officer. Already a wealthy man, Jobs insisted on taking a cash salary of $1 per year. At year-end 1999, to thank Jobs for serving as CEO for the previous 2.5 years without compensation, the board presented him with his very own Gulfstream jet at a cost to the company of a mere $90 million. The next month, Jobs agreed to drop interim from his job title, and the board rewarded him with options on 20 million shares. Until then, Jobs had held a grand total of 2 shares of Apple stock. The principle behind such option grants is to align the interests of managers with outside investors. If you are an outside Apple shareholder, you want its managers to be rewarded only if Apple's stock earns superior returns. Nothing else could possibly be fair to you and the other owners of the company. But as John Bogle, former chairman of the Vanguard Funds, points out, nearly all managers sell the stock they receive immediately after exercising their options. How could dumping millions of shares for an instant profit possibly align their interests with those of the company's loyal long-term shareholders? In Jobs' case, if Apple stock rises by just 5% annually through the beginning of 2010, he will be able to cash in his options for $548.3 million. In other words, even if Apple's stock earns no better than half the long-term average return of the overall stock market, Jobs will land a $500 million windfall. Does that align his interests with those of Apple's shareholders, or malign the trust that Apple's shareholders have placed in the board of directors? Reading proxy statements vigilantly, the intelligent owner will vote against any executive compensation plan that uses option grants to turn more than 3% of the company's shares outstanding over to the managers. And you should veto any plan that does not make option grants contingent on a fair and enduring measure of superior results, say outperforming the average stock in the same industry for a period of at least 5 years. No CEO ever deserves to make himself rich if he has produced poor results for you. A final thought. Let's go back to Graham's suggestion that every company's independent board members should have to report to the shareholders in writing on whether the business is properly managed on behalf of its true owners. What if the independent directors also had to justify the company's policies on dividends and share repurchases? What if they had to describe exactly how they determined that the company's senior management was not overpaid? And what if every investor became an intelligent owner and actually read that report? Chapter 20. Margin of Safety as the Central Concept of Investment. In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, "This too will pass." Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. This is the thread that runs through all the preceding discussion of investment policy, often explicitly, sometimes in a less direct fashion. Let us try now, briefly, to trace that idea in a connected argument. All experienced investors recognize that the margin of safety concept is essential to the choice of sound bonds and preferred stocks. For example, a railroad should have earned its total fixed charges better than 5 times before income tax, taking a period of years for its bonds to qualify as investment-grade issues. This past ability to earn in excess of interest requirements constitutes the margin of safety that is counted on to protect the investor against loss or discomfiture in the event of some future decline in net income. The margin above charges may be stated in other ways, for example, in the percentage by which revenues or profits may decline before the balance after interest disappears. But the underlying idea remains the same. The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demanded might be small. Nor does he rely to any controlling extent on his judgment as to whether future earnings will be materially better or poorer than in the past. If he did that, he would have to measure his margin in terms of a carefully projected income account, instead of emphasizing the margin shown in the past record. Here the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. If the margin is a large one, then it is enough to assume that the future earnings will not fall far below those of the past, in order for an investor to feel sufficiently protected against the vicissitudes of time. The margin of safety for bonds may be calculated alternatively by comparing the total value of the enterprise with the amount of debt. A similar calculation may be made for a preferred stock issue. If the business owes $10 million and is fairly worth $30 million, there is room for a shrinkage of 2/3 in value, at least theoretically, before the bondholders will suffer loss. The amount of this extra value or cushion above the debt may be approximated by using the average market price of the junior stock issues over a period of years. Since average stock prices are generally related to average earning power, the margin of enterprise value over debt and the margin of earnings over charges will in most cases yield similar results. So much for the margin of safety concept as applied to fixed value investments. Can it be carried over into the field of common stocks? Yes, but with some necessary modifications. There are instances where a common stock may be considered sound because it enjoys a margin of safety as large as that of a good bond. This will occur, for example, when a company has outstanding only common stock that under depression conditions is selling for less than the amount of bonds that could safely be issued against its property and earning power. That was the position of a host of strongly financed industrial companies at the low price levels of 1932 through 33. In such instances, the investor can obtain the margin of safety associated with a bond, plus all the chances of larger income and principal appreciation inherent in a common stock. The only thing he lacks is the legal power to insist on dividend payments, or else. But this is a small drawback as compared with his advantages. Common stocks bought under such circumstances will supply an ideal, though infrequent, combination of safety and profit opportunity. As a quite recent example of this condition, let us mention once more National Presto Industries stock, which sold for a total enterprise value of $43 million in 1972. With its $16 million of recent earnings before taxes, the company could easily have supported this amount of bonds. In the ordinary common stock bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the going rate for bonds. In former editions, we elucidated this point with the following figures. Assume in a typical case that the earning power is 9% on the price and that the bond rate is 4%. Then the stock buyer will have an average annual margin of 5% accruing in his favor. Some of the excess is paid to him in the dividend rate, even though spent by him, it enters into his overall investment result. The undistributed balance is reinvested in the business for his account. In many cases, such reinvested earnings fail to add commensurately to the earning power and value of his stock. That is why the market has a stubborn habit of valuing earnings dispersed in dividends more generously than the portion retained in the business. But if the picture is viewed as a whole, there is a reasonably close connection between the growth of corporate surpluses through reinvested earnings and the growth of corporate values. Over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety, which under favorable conditions will prevent or minimize a loss. If such a margin is present in each of a diversified list of 20 or more stocks, the probability of a favorable result under fairly normal conditions becomes very large. That is why the policy of investing in representative common stocks does not require high qualities of insight and foresight to work out successfully. If the purchases are made at the average level of the market over a span of years, the prices paid should carry with them assurance of an adequate margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market, or in buying non-representative common stocks that carry more than average risk of diminished earning power. As we see it, the whole problem of common stock investment under 1972 conditions lies in the fact that in a typical case, the earning power is now much less than 9% on the price paid. Let us assume that by concentrating somewhat on the low multiplier issues among the large companies, a defensive investor may now acquire equities at 12 times recent earnings, for example, with an earnings return of 8.33% on cost. He may obtain a dividend yield of about 4%, and he will have 4.33% of his cost reinvested in the business for his account. On this basis, the excess of stock earning power over bond interest over a 10-year basis would still be too small to constitute an adequate margin of safety. For that reason, we feel that there are real risks now, even in a diversified list of sound common stocks. The risks may be fully offset by the profit possibilities of the list, and indeed the investor may have no choice but to incur them, for otherwise he may run an even greater risk of holding only fixed claims payable in steadily depreciating dollars. Nonetheless, the investor would do well to recognize and to accept as philosophically as he can that the old package of good profit possibilities combined with small ultimate risk is no longer available to him. However, the risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. Observation over many years has taught us that the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. The purchasers view the current good earnings as equivalent to earning power and assume that prosperity is synonymous with safety. It is in those years that bonds and preferred stocks of inferior grade can be sold to the public at a price around par, because they carry a little higher income return or a deceptively attractive conversion privilege. It is then also that common stocks of obscure companies can be floated at prices far above the tangible investment on the strength of 2 or 3 years of excellent growth. These securities do not offer an adequate margin of safety in any admissible sense of the term. Coverage of interest charges and preferred dividends must be tested over a number of years. including, preferably, a period of subnormal business, such as in 1970 through 71. The same is ordinarily true of common stock earnings, if they are to qualify as indicators of earning power. Thus it follows that most of the fair weather investments, acquired at fair weather prices, are destined to suffer disturbing price declines when the horizon clouds over, and often sooner than that. Nor can the investor count with confidence on an eventual recovery, although this does come about in some proportion of the cases, for he has never had a real safety margin to tide him through adversity. The philosophy of investment in growth stocks parallels in part and in part contravenes the margin of safety principle. The growth stock buyer relies on an expected earning power that is greater than the average shown in the past. Thus he may be said to substitute these expected earnings for the past record in calculating his margin of safety. In investment theory, there is no reason why carefully estimated future earnings should be a less reliable guide than the bare record of the past. In fact, security analysis is coming more and more to prefer a competently executed evaluation of the future. Thus, the growth stock approach may supply as dependable a margin of safety as is found in the ordinary investment, provided the calculation of the future is conservatively made, and provided it shows a satisfactory margin in relation to the price paid. The danger in a growth stock program lies precisely here. For such favored issues, the market has a tendency to set prices that will not be adequately protected by a conservative projection of future earnings. It is a basic rule of prudent investment that all estimates, when they differ from past performance, must err at least slightly on the side of understatement. The margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. If, as we suggest, the average market level of most growth stocks is too high to provide an adequate margin of safety for the buyer, then a simple technique of diversified buying in this field may not work out satisfactorily. A special degree of foresight and judgment will be needed, in order that wise individual selections may overcome the hazards inherent in the customary market level of such issues as a whole. The margin of safety idea becomes much more evident when we apply it to the field of undervalued or bargain securities. We have here, by definition, a favorable difference between price on the one hand and indicated or appraised value on the other. That difference is the safety margin. It is available for absorbing the effect of miscalculations or worse than average luck. The buyer of bargain issues places particular emphasis on the ability of the investment to withstand adverse developments. For in most such cases, he has no real enthusiasm about the company's prospects. True, if the prospects are definitely bad, the investor will prefer to avoid the security no matter how low the price. But the field of undervalued issues is drawn from the many concerns, perhaps a majority of the total, for which the future appears neither distinctly promising nor distinctly unpromising. If these are bought on a bargain basis, even a moderate decline in the earning power need not prevent the investment from showing satisfactory results. The margin of safety will then have served its proper purpose. Theory of diversification. There is a close logical connection between the concept of a safety margin and the principle of diversification. One is correlative with the other. Even with a margin in the investor's favor, an individual security may work out badly, for the margin guarantees only that he has a better chance for profit than for loss, not that loss is impossible. But as the number of such commitments is increased, the more certain does it become that the aggregate of the profits will exceed the aggregate of the losses. That is the simple basis of the insurance underwriting business. Diversification is an established tenet of conservative investment. By accepting it so universally, investors are really demonstrating their acceptance of the margin of safety principle, to which diversification is the companion. This point may be made more colorful by a reference to the arithmetic of roulette. If a man bets $1 on a single number, he is paid $35 profit when he wins, but the chances are 37 to 1 that he will lose. He has a negative margin of safety. In his case, diversification is foolish. The more numbers he bets on, the smaller his chance of ending with a profit. If he regularly bets $1 on every number, including 0 and 00, he is certain to lose $2 on each turn of the wheel. But suppose the winner received $39 profit instead of $35. Then he would have a small but important margin of safety. Therefore, the more numbers he wagers on, the better his chance of gain. And he could be certain of winning $2 on every spin by simply betting $1 each on all the numbers. Incidentally, the two examples given actually describe the respective positions of the player and proprietor of a wheel with 0 and 00. A criterion of investment versus speculation. Since there is no single definition of investment in general acceptance, authorities have the right to define it pretty much as they please. Many of them deny that there is any useful or dependable difference between the concepts of investment and of speculation. We think this skepticism is unnecessary and harmful. It is injurious because it lends encouragement to the innate learning of many people toward the excitement and hazards of stock market speculation. We suggest that the margin of safety concept may be used to advantage as the touchstone to distinguish an investment operation from a speculative one. Probably most speculators believe they have the odds in their favor when they take their chances, and therefore they may lay claim to a safety margin in their proceedings. Each one has the feeling that the time is propitious for his purchase, or that his skill is superior to the crowd's, or that his advisor or system is trustworthy. But such claims are unconvincing. They rest on subjective judgment, unsupported by any body of favorable evidence or any conclusive line of reasoning. We greatly doubt whether the man who stakes money on his view that the market is heading up or down can ever be said to be protected by a margin of safety in any useful sense of the phrase. By contrast, the investor's concept of the margin of safety, as developed earlier in this chapter, rests upon simple and definite arithmetical reasoning from statistical data. We believe also that it is well supported by practical investment experience. There is no guarantee that this fundamental quantitative approach will continue to show favorable results under the unknown conditions of the future. But, equally, there is no valid reason for pessimism on this score. Thus, in sum, we say that to have a true investment, there must be present a true margin of safety, and a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. Extension of the concept of investment. To complete our discussion of the margin of safety principle, we must now make a further distinction between conventional and unconventional investments. Conventional investments are appropriate for the typical portfolio. Under this heading have always come United States government issues and high-grade dividend-paying common stocks. We have added state and municipal bonds for those who will benefit sufficiently by their tax-exempt features. Also included are first-quality corporate bonds, when, as now, they can be bought to yield sufficiently more than United States savings bonds. Unconventional investments are those that are suitable only for the enterprising investor. They cover a wide range. The broadest category is that of undervalued common stocks of secondary companies, which we recommend for purchase when they can be bought at 2/3 or less of their indicated value. Besides these, there is often a wide choice of medium-grade corporate bonds and preferred stocks, when they're selling at such depressed prices as to be obtainable also at a considerable discount from their apparent value. In these cases, the average investor would be inclined to call the securities speculative, because in his mind, their lack of a first-quality rating is synonymous with a lack of investment merit. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity, provided that the buyer is informed and experienced and that he practices adequate diversification. For if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Our favorite supporting illustration is taken from the field of real estate bonds. In the 1920s, billions of dollars worth of these issues were sold at par and widely recommended as sound investments. A large proportion had so little margin of value over debt as to be in fact highly speculative in character. In the Depression of the 1930s, an enormous quantity of these bonds defaulted their interest, and their price collapsed, in some cases below 10 cents on the dollar. At that stage, the same advisors who had recommended them at par as safe investments were rejecting them as paper of the most speculative and unattractive type. But as a matter of fact, the price depreciation of about 90% made many of these securities exceedingly attractive and reasonably safe, for the true values behind them were 4 or 5 times the market quotation. The fact that the purchase of these bonds actually resulted in what is generally called a large speculative profit did not prevent them from having true investment qualities at their low prices. The speculative profit was the purchaser's reward for having made an unusually shrewd investment. They could properly be called investment opportunities, since a careful analysis would have shown that the excess of value over price provided a large margin of safety. Thus, the very class of fair-weather investments, which we stated before, is a chief source of serious loss to naive security buyers, is likely to afford many sound profit opportunities to the sophisticated operator, who may buy them later at pretty much his own price. The whole field of special situations would come under our definition of investment operations, because the purchase is always predicted on a thoroughgoing analysis that promises a larger realization than the price paid. Again, there are risk factors in each individual case, but these are allowed for in the calculations and absorbed in the overall results of a diversified operation. To carry this discussion to a logical extreme, we might suggest that a defensible investment operation could be set up by buying such intangible values as are represented by a group of common stock option warrants, selling at historically low prices. This example is intended as somewhat of a shocker. The entire value of these warrants rests on the possibility that the related stocks may someday advance above the option price. At the moment, they have no exercisable value. Yet, since all investment rests on reasonable future expectations, it is proper to view these warrants in terms of the mathematical chances that some future bull market will create a large increase in their indicated value and in their price. Such a study might well yield the conclusion that there is much more to be gained in such an operation than to be lost, and that the chances of an ultimate profit are much better than those of an ultimate loss. If that is so, there is a safety margin present even in this unprepossessing security form. A sufficiently enterprising investor could then include an option warrant operation in his miscellany of unconventional investments. To sum up, investment is most intelligent when it is most businesslike. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they've gained success in their own undertakings. Yet every corporate security may best be viewed, in the first instance, as an ownership interest in or a claim against a specific business enterprise. And if a person sets out to make profits from security purchases and sales, he is embarking on a business venture of his own, which must be run in accordance with accepted business principles if it is to have a chance of success. The first and most obvious of these principles is know what you're doing, know your business. For the investor, this means do not try to make business profits out of securities, that is, returns in excess of normal interest and dividend income, unless you know as much about security values as you would need to know about the value of merchandise that you propose to manufacture or deal in. A second business principle: do not let anyone else run your business, unless 1. You can supervise his performance with adequate care and comprehension, or 2, you have unusually strong reasons for placing implicit confidence in his integrity and ability. For the investor, this rule should determine the conditions under which he will permit someone else to decide what is done with his money. A third business principle: do not enter upon an operation, that is, manufacturing or trading in an item, unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. In particular, keep away from ventures in which you have little to gain and much to lose. For the enterprising investor, this means that his operations for profit should be based not on optimism but on arithmetic. For every investor, it means that when he limits his return to a small figure, as formerly at least in a conventional bond or preferred stock, he must demand convincing evidence that he is not risking a substantial part of his principal. A fourth business rule is more positive. Have the courage of your knowledge and experience. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it, even though others may hesitate or differ. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Similarly, in the world of securities, courage becomes the supreme virtue after adequate knowledge and a tested judgment are at hand. Fortunately for the typical investor, it is by no means necessary for his success that he bring these qualities to bear upon his program, provided he limits his ambition to his capacity and confines his activities within the safe and narrow path of standard defensive investment. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Commentary on Chapter 20. If we fail to anticipate the unforeseen, or expect the unexpected in a universe of infinite possibilities, we may find ourselves at the mercy of anyone or anything that cannot be programmed, categorized, or easily referenced. Agent Fox Mulder, The X-Files. First, don't lose. What is risk? You'll get different answers depending on whom and when you ask. In 1999, risk didn't mean losing money. It meant making less money than someone else. What many people feared was bumping into somebody at a barbecue who was getting even richer, even quicker by day trading .com stocks than they were. Then, quite suddenly, by 2003, risk had come to mean that the stock market might keep dropping until it wiped out whatever traces of wealth you still had left. While its meaning may seem nearly as fickle and fluctuating as the financial markets themselves, risk has some profound and permanent attributes. The people who take the biggest gambles and make the biggest gains in a bull market are almost always the ones who get hurt the worst in the bear market that inevitably follows. Being right makes speculators even more eager to take extra risk, as their confidence catches fire. And once you lose big money, you then have to gamble even harder just to get back to where you were, like a racetrack or casino gambler who desperately doubles up after every bad bet. Unless you are phenomenally lucky, that's a recipe for disaster. No wonder, when he was asked to sum up everything he had learned in his long career about how to get rich, the legendary financier J.K. Klingenstein of Wertheim & Company answered simply, "Don't lose." The graph in Figure 20-1 shows what he meant. Losing some money is an inevitable part of investing, and there's nothing you can do to prevent it. But to be an intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. The Hindu goddess of wealth, Lakshmi, is often portrayed standing on tiptoe, ready to dart away in the blink of an eye. To keep her symbolically in place, some of Lakshmi's devotees will lash her statue down with strips of fabric or nail its feet to the floor. For the intelligent investor, Graham's margin of safety performs the same function. By refusing to pay too much for an investment, you minimize the chances that your wealth will ever disappear or suddenly be destroyed. Consider this. Over the 4 quarters ending in December 1999, JDS Uniphase Corporation, the fiber optics company, generated $673 million in net sales, on which it lost $313 million. Its tangible assets totaled $1.5 billion. Yet on March 7, 2000, JDS Uniphase's stock hit $153 a share, giving the company a total market value of roughly $143 billion. And then, like most new-era stocks, it crashed. Anyone who bought it that day and still clung to it at the end of 2002 faced these prospects, which can be found on the enhancement in Figure 20-2. Even at a robust 10% annual rate of return, it will take more than 43 years to break even on this overpriced purchase. The risk is not in our stocks, but in ourselves. Risk exists in another dimension, inside you. If you overestimate how well you really understand an investment, or overstate your ability to ride out a temporary plunge in prices, it doesn't matter what you own or how the market does. Ultimately, financial risk resides not in what kinds of investments you have, but in what kind of investor you are. If you want to know what risk really is, go to the nearest bathroom and step up to the mirror. That's risk, gazing back at you from the glass. As you look at yourself in the mirror, what should you watch for? The Nobel Prize-winning psychologist Daniel Kahneman explains 2 factors that characterize good decisions. Well-calibrated confidence. Do I understand this investment as well as I think I do? Correctly anticipated regret. How will I react if my analysis turns out to be wrong? To find out whether your confidence is well calibrated, look in the mirror and ask yourself, what is the likelihood that my analysis is right? Think carefully through these questions. How much experience do I have? What is my track record with similar decisions in the past? What is the typical track record of other people who've tried this in the past? If I'm buying, someone else is selling. How likely is it that I know something that this other person or company does not know? If I am selling, someone else is buying. How likely is it that I know something that this other person or company does not know? Have I calculated how much this investment needs to go up for me to break even after my taxes and costs of trading? Next, look in the mirror to find out whether you are the kind of person who correctly anticipates your regret. Start by asking, do I fully understand the consequences if my analysis turns out to be wrong? Answer that question by considering these points. If I'm right, I can make a lot of money. But what if I'm wrong? Based on the historical performance of similar investments, how much could I lose? Do I have other investments that will tide me over if this decision turns out to be wrong? Do I already hold stocks, bonds, or funds with a proven record of going up when the kind of investment I'm considering goes down? Am I putting too much of my capital at risk with this new investment? When I tell myself you have a high tolerance for risk, how do I know? Have I ever lost a lot of money on an investment? How did it feel? Did I buy more, or did I bail out? Am I relying on my willpower alone to prevent me from panicking at the wrong time? Or have I controlled my own behavior in advance by diversifying, signing an investment contract, and dollar-cost averaging? You should always remember, in the words of the psychologist Paul Slovic, that risk is brewed from an equal dose of 2 ingredients, probabilities and consequences. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. Pascal's wager. The investment philosopher Peter Bernstein has another way of summing this up. He reaches back to Blaise Pascal, the great French mathematician and theologian, 1623 through 1662, who created a thought experiment in which an agnostic must gamble on whether or not God exists. The ante this person must put up for the wager is his conduct in this life. The ultimate payoff in the gamble is the fate of his soul in the afterlife. In this wager, Pascal asserts, reason cannot decide the probability of God's existence. Either God exists or he does not, and only faith, not reason, can answer that question. But while the probabilities in Pascal's wager are a toss-up, the consequences are perfectly clear and utterly certain. As Bernstein explains, suppose you act as though God is, and you lead a life of virtue and abstinence, when in fact there is no God. You will have passed up some goodies in life, but there will be rewards as well. Now suppose you act as though God is not, and spend a life of sin, selfishness, and lust, when in fact God is. You may have had fun and thrills during the relatively brief duration of your lifetime, but when the day of judgment rolls around, you are in big trouble. Concludes Bernstein, in making decisions under conditions of uncertainty, the consequences must dominate the probabilities. We never know the future. Thus, as Graham has reminded you in every chapter of this book, the intelligent investor must focus not just on getting the analysis right. You must also insure against loss if your analysis turns out to be wrong, as even the best analyses will be at least some of the time. The probability of making at least one mistake at some point in your investing lifetime is virtually 100%, and those odds are entirely out of your control. However, you do have control over the consequences of being wrong. Many investors put essentially all of their money into .com stocks in 1999. An online survey of 1,338 Americans by Money Magazine in 1999 found that nearly 1/10 of them had at least 85% of their money in internet stocks. By ignoring Graham's call for a margin of safety, these people took the wrong side of Pascal's wager. Certain that they knew the probabilities of being right, they did nothing to protect themselves against the consequences of being wrong. Simply by keeping your holdings permanently diversified and refusing to fling money at Mr. Market's latest, craziest fashions, you can ensure that the consequences of your mistakes will never be catastrophic. No matter what Mr. Market throws at you, you will always be able to say, with a quiet confidence, "This too shall pass away." Postscript. We know very well two partners who spent a good part of their lives handling their own and other people's funds on Wall Street. Some hard experience taught them it was better to be safe and careful, rather than to try to make all the money in the world. They established a rather unique approach to security operations, which combined good profit possibilities with sound values. They avoided anything that appeared overpriced and were rather too quick to dispose of issues that had advanced to levels they deemed no longer attractive. Their portfolio was always well diversified, with more than 100 different issues represented. In this way, they did quite well through many years of ups and downs in the general market. They averaged about 20% per annum on the several millions of capital they had accepted for management, and their clients were well pleased with the results. In the year in which the first edition of this book appeared, an opportunity was offered to the Partners Fund to purchase a half interest in a growing enterprise. For some reason, the industry did not have Wall Street appeal at the time, and the deal had been turned down by quite a few important houses. But the pair was impressed by the company's possibilities. What was decisive for them was that the price was moderate in relation to current earnings and asset value. The partners went ahead with the acquisition, amounting in dollars to about 1/5 of their fund. They became closely identified with the new business interest, which prospered. In fact, it did so well that the price of its shares advanced to 200 times or more the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start the quotation appeared much too high in terms of the partners' own investment standards. But since they regarded the company as a sort of family business, they continued to maintain a substantial ownership of the shares, despite the spectacular price rise. A large number of participants in their funds did the same, and they became millionaires through their holding in this one enterprise, plus later organized affiliates. Ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations in the partners' specialized fields, involving much investigation, endless pondering, and countless individual decisions. Are there morals to this story of value to the intelligent investor? An obvious one is that there are several different ways to make and keep money in Wall Street. Another, not so obvious, is that one lucky break, or one supremely shrewd decision, can we tell them apart, may count for more than a lifetime of journeyman efforts. But behind the luck, or the crucial decision, there must usually exist a background of preparation and discipline capacity. One needs to be sufficiently established and recognized so that these opportunities will knock at his particular door. One must have the means, the judgment, and the courage to take advantage of them. Of course, we cannot promise a like spectacular experience to all intelligent investors who remain both prudent and alert through the years. We are not going to end with J.J. Raskob's slogan that we made fun of at the beginning: everybody can be rich. But interesting possibilities abound on the financial scene, and the intelligent and enterprising investor should be able to find both enjoyment and profit in this three-ring circus. Excitement is guaranteed. Commentary on Postscript. Successful investing is about managing risk, not avoiding it. At first glance, when you realize that Graham put 25% of his fund into a single stock, you might think he was gambling rashly with his investors' money. But then, when you discover that Graham had painstakingly established that he could liquidate Geico for at least what he paid for it, it becomes clear that Graham was taking very little financial risk. But he needed enormous courage to take the psychological risk of such a big bet on so unknown a stock. And today's headlines are full of fearful facts and unresolved risks. The death of the 1990s bull market, sluggish economic growth, corporate fraud, the specters of terrorism and war. Investors don't like uncertainty. A market strategist is intoning right now on financial TV or in today's newspaper. But investors have never liked uncertainty, and yet it is the most fundamental and enduring condition of the investing world. It always has been, and it always will be. At heart, uncertainty and investing are synonyms. In the real world, no one has ever been given the ability to see that any particular time is the best time to buy stocks. Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow. The most literate of investors, Graham loved the stories of Ulysses, told through the poetry of Homer, Alfred Tennyson, and Dante. Late in his life, Graham relished the scene in Dante's Inferno, when Ulysses describes inspiring his crew to sail westward into the unknown waters beyond the gates of Hercules. "Oh, brothers," I said, "who after 100,000 perils have reached the west, in this little waking vigil that still remains to our senses, let us not choose to avoid the experience of the unpeopled world that lies behind the sun. Consider the seeds from which you sprang. You were made not to live like beasts, but to seek virtue and understanding." With this little oration I made my shipmates so eager for the voyage that it would have hurt to hold them back. and we swung our stern toward the morning and turned our oars into wings for the wild flight. Investing, too, is an adventure. The financial future is always an uncharted world. With Graham as your guide, your lifelong investing voyage should be as safe and confident as it is adventurous. This is Luke Daniels. We hope you've enjoyed this unabridged production of The Intelligent Investor, a book of practical counsel, revised edition, by Benjamin Graham, updated with new commentary by Jason Zweig. This program was produced by Common Mode, Paul Fowley, Technical Director. Executive Producer Katie Ostroka. Copyright 1973 by Benjamin Graham. New material copyright 2003 by Jason Zweig. Production copyright 2015 by HarperCollins Publishers. All rights reserved. Thank you for listening.